Robust January hiring reinforces Federal Reserve's pause on interest rates. Fresh labor market data has strengthened the Federal Reserve's resolve to maintain its current interest rate stance as January employment figures revealed a stronger than anticipated start to 2026 for the US economy. According to newly released data from the US Bureau of Labor Statistics, non-farm payrolls rose by 130,000 in January, nearly double the 70,000 economists has forecast. Meanwhile, the unemployment rate edged down to 4.3%, signaling renewed resilience in a labor market that many policymakers had feared was losing momentum. The data arrives at a critical juncture of the Federal Reserve, which last month voted 10 to keep short-term borrowing costs steady within the 3.50% to 3.75% range. The decision followed a series of rate cuts in late 2025 and reflected policymakers' attempt to balance moderating labor conditions against persistent inflationary pressures. Market participants responded swiftly to the stronger employment figures. Traders in interest rate futures significantly reduced expectation of an imminent rate cut, pricing in only a modest probability of a move by April. While June remains the most likely window for policy easing, confidence in that timeline has diminished, with investors now assigning a notably higher chance that the Fed may once again stand pat. Analysts argue the report offers clear support to the more cautious faction within the central bank. The data reinforces the narrative of a stabilizing labor market, suggesting that the urgency of additional monetary stimulus has receded, particularly as inflation continues to hover above the Fed's long-term target. However, the broader labor picture remained nuanced. Revision to 2025 employment figure revealed that last year's average monthly job growth stood at a mere 15,000, and usually subdued pace, more commonly associated with the onset of the recession than sustained expansion. Despite last year's weakness, January's rebound has lifted the recent 3-month average to approximately 73,000, offering evidence that labor conditions may be stabilizing rather than deteriorating further. The data also tempers concern previously raised by Fed Governor Christopher Waller, who had argued that the labor market in 2025 was weaker than widely perceived and vulnerable to sharper contraction. While revisions confirmed softness, they did not validate fears of near-zero job growth. With downside labor risk appearing less acute, attention now shifts decisively toward inflation. Several Fed officials, including Dallas Fed President Lori Logan, have indicated that price stability, not employment weakness, remains more pressing concern. The next consumer inflation report due later this week will be closely scrutinized for signs that underlying price pressures continue to persist.